Welcome back to It's Your Money, the ultimate destination for all things options trading. Are you ready to take your options trading to the next level? Options trading can be a complex field, and having a solid understanding of the different option Greeks can help you make informed decisions and increase your chances of success. In this video, we'll focus on one of the most important option Greeks, gamma, and explore its role in options trading. If you've been following our series on options trading, you know that the Greeks can provide important information about the price and risk of an option trade. Gamma specifically measures the rate of change in the delta of an option. Understanding gamma's impact on delta is crucial if you want to be a successful options trader. By the end of this video, you'll have a solid understanding of how gamma affects delta, and how this knowledge can give you an edge when trading stock options. And if you missed any of our previous videos, don't worry. You can catch up by clicking on the links in the description or in the cards above. Are you ready to start trading like a pro? Then, let's dive right in. Option gamma explained. Gamma is a term used in options trading to measure theoretical rate of change in the delta of an option. You should already know, delta measures the sensitivity of an option's price to changes in the price of the underlying stock. In simple terms, delta helps you know theoretically how much your option's premium will rise or fall in relation to the stock's price. And delta is a good indicator whether your option would be profitable or not. Now, let's talk about gamma. The gamma of an option is one factor that tells us how much the delta of the option will change for every 1-point move in the price of the underlying stock. It is worth noting that the delta and gamma of an option can be influenced by other factors as well, such as volatility, you will learn is represented by the option Greek vega. Interest rates, which is represented by the option Greek rho. Time to expiration, which is represented by the option Greek theta. We will be discussing vega in our next video. So be sure you are subscribed to our channel for the updates. But with all of these factors in mind, gamma's role is to measure the rate at which the value of an option's delta is expected to change in response to changes in the price of the underlying stock. Now remember, you wanted to purchase an Apple January call in a previous video. You were going to have to put down a deposit, or what is known in options trading as the options premium. Then, remember the options delta was 0.52, which meant hypothetically the option price should rise 52 cents for every dollar Apple went up. Well, now consider our example here. You have a strong hunch that the stock of BBBY is about to soar past $3 a share. The stock is currently trading at $2.82 per share, and you're thinking about buying the BBBY February 23, 2023 call option. You see that the BBBY $3 call option for February costs 22 cents for the right to purchase 100 shares of BBBY on or before February 23, 2023. You notice that the delta of the option is slightly below average at 0.42. And do you remember what we learned about delta? That means that you can expect the BBBY $3 February call options premium price to move approximately 42 cents for every dollar that BBBY stock goes up or down. A closer look at options gamma. Here is what you need to know about gamma, so write it down and don't forget. Delta is an indicator how much an options premium will move up or down, or more accurately should move up or down if the price of your stock moves $1. And gamma is an indicator how much the options, delta, will move or should move if your stock goes up $1. Again, you will also have to filter in both market and company news. But just like you learned that delta moves the options premium, gamma is an indicator that lets you know how much you can expect the delta's number to move. You can consider gamma as the ramp that shows you how fast an options premium will move. It is gauged from 0.01 to 1.0. And the higher the gamma's number is will determine how fast the delta will climb up or fall down. Delta will move rather quickly if the gamma's number is high. Or you can expect that options delta to climb slowly if the gamma is low. In our example we have a gamma of 0.51, which indicates that the delta of the option is expected to change rapidly in response to small changes in the price of the underlying stock. In other words, you purchased the option and paid a premium of 22 cents for the right to buy 100 shares of BBBY at $3. Now, if BBBY moves up from $2.82 to $3.82, then theoretically your options premium should increase to 72 cents. However, this is only an estimate because you also have to filter in company news and market conditions. Now, how does gamma fit into the equation? When the underlying stock price changes, the delta will change also, and the change in delta will be influenced by the gamma. And if your stock moves up $1, the delta will also go up, which you will see is a good thing. And the gamma will influence how much the delta will change. It's simple. You will understand completely in just a few moments. But for now, let's look at our example here again. BBBY is trading at $2.82. Its options premium is 22 cents. The delta is 0.42. And the gamma is 0.51. This means that if BBBY goes up to $3.82, then we would expect your options premium to go up 42 cents because of the delta. And if BBBY goes up $1 to $3.82, the delta will change also. The change in the delta is influenced by how high the gamma is. Now, the gamma is 0.51, which means the options delta will move rapidly. And that is exactly what you want. Why? Because if delta tells us the approximate rise we can expect in the options premium, then we want the delta to climb quickly as well. Again, why? Because the faster the delta climbs, the faster the options premium should go up, which means you can potentially make a higher profit. So together they are important factors to consider when trading options, because it helps traders to determine how their options positions are likely to behave in response to price changes in your stock. Understanding the concept of gamma can help traders make more informed decisions about when to enter or exit trades and how to manage risk. Conclusion: you should consider delta as the center of the compass and the other Greeks as the directions that contribute to the overall measurement of delta. The other Greeks, such as gamma, vega, rho, and theta, all influence delta in different ways and provide important information about the options price and risk. We will be covering each of them in future videos, so be sure to subscribe. Each Greek provides a unique perspective on the options behavior. Gamma's contribution to the options behavior is that it measures the rate of change in the delta of an option. And why is that important? Because a rising delta indicates that the options premium is expected to rise more quickly if your stock's price rises. And you make more money. It's important to keep in mind that while a high gamma and delta are desirable in certain circumstances, they are only one part of the overall picture. You also need to consider other factors like theta, vega, and rho, as well as market conditions and the underlying stock's behavior. Making informed trading decisions requires taking a comprehensive view of all of these factors and making an informed decision based on your risk tolerance and investment goals. If you made it this far in the video, we would love to hear your thoughts. Have you watched our other videos on options trading? If you, do us some love and leave a comment on at least one thing you have learned, or if you have any questions. Just let us know. And I will see you in the next video.